pandemic, recession, and inflation.
Everyone's looking at the same numbers, but there were 2 points of view that were very different from one another. One was the economy's charging ahead, inflation's going to continue, rates will continue to go up, we don't think there'll be a recession, and so forth. And then the other one is, whoa, watch out, inventories are building, consumption is slowing down, consumer sentiment is falling apart. We risk a recession here. And oh, by the way, China and Europe are in recession. Well, I think that the first camp is capitulating to the second camp. It's still fighting this notion that GDP actually fell. This in real terms now. Take away inflation, GDP unit growth fell quarter to quarter at an annual rate by 1.4%. The consumption of goods slipped slightly. That's what we're expecting. Meanwhile, inventories are piling up. Government spending went down, as I mentioned. Imports surged. And so a lot of those economists and strategists in the first camp were saying, oh, that's exogenous. That's an anomaly. You've got to adjust for that. No, you don't. Imports surged and went straight into inventories. They canceled each other out.
So that was Cathie Wood's 2 points of view on the market right now. On one hand, economy is charging ahead, rates are going up, and inflation is nowhere to end, and there will be no recession. On the other hand, there are murmurs of an impending recession. Consumption is slowing down, inventories are building up. China and Europe are in recession. So which is it? Is the economy charging ahead, or is a recession on the horizon? The answer? It's complicated. In this video, I'm going to share Cathie Wood's viewpoint on what's really happening in the market. So stay tuned till the last to not miss any updates.
A recession is quite possible here in the United States. A recession is defined as 2 consecutive quarters of declines in GDP. We've had one, and I wouldn't be surprised to see another either in the second quarter or the third. So technically, we would, if we were positive in the second and went negative again in the third, that's not a technical recession. But in my book, it's close enough.
Cathie Wood fears that we could be in a recession. According to her, the global economy is in recession, and the recent stock market volatility is a sign investors believe that the Federal Reserve's plan to continue hiking interest rates is too aggressive.
Now, I know you've been bombarded by headlines about inflation, and we are not ignoring them. Did we expect supply chain issues, the magnitude of what we've seen, or zero COVID policy in China, or Russia's invasion of Ukraine? Absolutely not. Have we been wrong on how quickly inflation would dissipate? Absolutely. For those reasons, we believe. So let's just face the music. PPI inflation up 11.2% year over year. CPI up 8.5%. Personal consumption deflator up 5.2%. And the metric that the Fed pays the most attention to is core PCE deflator, core personal consumption expenditures deflator. So that's excluding food and energy, which they consider to be very volatile, more volatile than the underlying. Core inflation is 5.2%.
She shared the reports emphasizing how PPI, CPI, personal consumption deflator, and core inflation are all high on a year-over-year basis. So you see input prices are rising higher than output prices. You must be wondering why PPI is rising faster than the CPI. Right! What does that mean? Is it a sign of impending inflation? Let us try to understand this in detail. But before that, give this video a big thumbs up if you like the content. Let's hear her out.
That means margin degradation, probably. So disappointing profits for companies that are not controlling their expenses, perhaps by using more automation and increasing productivity. Again, innovation solves problems. This is going to become a big problem. And we think that the adoption of innovative strategies to lower costs and sustain margins is going to become another mantra. Innovation solves problems. If you look at the personal consumption deflator, that too was up only 0.3% last month, which makes the second consecutive month it was up 0.3, and expectations are that the next month will be up 0.3. So here again, we have an annualized rate of about 3.5%, well below where we are now on the year-over-year basis. Now, what really shocked the markets this week was the productivity report. Productivity plummeted. Unit labor costs quarter to quarter at an annual rate. This is not year over year. This is quarter to quarter, annualized rate, up 11.6%. This is what's telling you we're going to see margin compression in corporate America. Now, the quarter before, it was 1%. So that's unit labor costs. The quarter before didn't seem to be a problem. Productivity was overtaking a lot of the wage, absorbing a lot of the wage growth. That was not true this last quarter, and it gets back to this idea that maybe we're hoarding labor. Maybe we're hoarding labor. And if we are, I have a feeling that margin compression will cause a disgorgement and an increase in the unemployment rate. The unemployment rate was 3.6% this last month. Didn't change from last month, but I have a feeling the puzzle we're putting together means that it will go up.
So what really shocked her is the productivity report, unit labor cost quarter-based annualized rate. Due to this, you can witness margin compression in corporate America. She explains that the market was not like this in the last quarter. She suspects that maybe we are hoarding labor. If that's true, margin compression will cause a disgorgement and the unemployment rate will rise. Let's hear what else Cathie has to say regarding the inflation.
More evidence that inflation is receding here already. If you look at used car prices, this was a leading indicator during the COVID crisis of how high inflation would go and how rapidly it would increase. At one point, used car prices were up 60% versus their pre-COVID level. Well, used car prices have been falling for 3 months now. They're now up 14% year over year, but I think at their peak on a year over year basis, they were up in the mid-40s. That 60% number was versus the pre-COVID level. So we've come down in used car price inflation from the mid-40s down to about 14%. And at the same time, one of the reasons is sales of used cars over a 1-month period dropped by 13%. And the Manheim Used Car Index folks, the people who put that together, remarked that this was highly unusual at this time because tax refunds usually cause an increase. So down 13%. And on a year-over-year basis, that takes used car sales down by 21%. New car sales are down 22% on a year-over-year basis. Car prices at one point, used and new, accounted for 1/3 of the increase in the inflation rate, and now they're reversing. So that's very important.
According to her, used car prices are a leading indicator of how inflation will go and how rapid it will go. Now, used car prices have been falling down for 3 months, but even still, sales of used cars over a 1-month period dropped by 13%. People are shifting to bikes, scooters, so maybe that could be the reason. Still, this is highly unusual at this time, because tax refunds usually cause an increase. Cathie explains that used cars and new cars account for 1/3 of the increase in inflation. But now, this trend is reversing. So what does that mean? Would it lead to a decreased inflation in the near future? Let me know your thoughts in the comments below.
Oil prices peaked in the 130s per barrel in March, and they're down to 110. Now, so that means they're down pretty significantly month to month. I don't know exactly the survey dates, what those prices were on those dates, but energy prices were the other reason behind the supercharged inflation rate we've seen. And now they're starting to come down. Now, if Russia-Ukraine gets worse, maybe we have a problem. If Europe basically says to Russia, we're not taking any more of your oil, maybe we have another shock. But I've actually been surprised. I would have expected more follow-through after that 130, given how serious this invasion has been. One of the reasons it probably hasn't happened is China. I think China's in recession. Europe's in recession. U.S. had a negative GDP quarter. There's demand destruction as people start substituting scooters and bikes and motorcycles for cars. So oil is no longer the propellant to inflation, at least not yet. And even wheat, food prices up a lot. And again, early March seemed to peak wheat, and it's down 5% in the last month. So maybe coming off the boil here, we shall see. And even in the technology space, we keep track of GPUs, semiconductors, and used in gaming and crypto. And on the secondary market, there was big speculation, there were shortages. Those have come off from 1,500, I think this is for the RTX GPU, NVIDIA's, have come off from 1,500 to 700. So they've been cut by more than half. So that's also quite interesting.
So you guys see, not only cars, the price of oil has been on a steady decline. The price of a barrel of oil was around $130. It came down to $110 last month. Cathie expects this downward trend will continue in the coming months. So why is this happening? There are a few reasons. Firstly, people are substituting cars with other modes of transportation, like bikes and scooters. Secondly, recession is going on in China and Europe, and there's also a negative GDP quarter. Food prices have also come down by 5% last month. However, the tide may be starting to turn. If you like this video, please give it a big thumbs up. Also hit that bell icon to never miss any updates on the market.
Chairman Powell said that inflation might have peaked in March. And so you can see some of the reasons he said that. And it's a good thing that he's thinking that, because we believe that the rate of interest rate increases right now is onerous for the economy. And I don't believe that 1.4% drop in GDP, even before this 50% rate hike, was a fluke. I think it's sending a real message to the Fed, as are some of these pricing indicators.
Now there's a dilemma, as the choice is between suffering high inflation or a recession. Hiking rates substantially would likely cool down the inflationary pressures, but it would also put us right into a recession. Jeremy Powell also recently confirmed that he can't guarantee a soft landing as they retake control of inflation. It may seem like we're set for more pain either way, and that's why the market has recently become so volatile. Still, Cathie Wood argues that now is the time to invest in stock that can grow, regardless of inflation or a recession. I agree that there are some opportunities in space. So that was it for today. Subscribe to my channel for more videos like this, and I'll see you in my next video.